back. Well, we have been getting you the biggest voices from the various investor conferences. There was Citi, Morgan Stanley, Sohn, UBS, and now we are getting you guests from the Ambit conference. That's going to happen in London. But Pramod Gubbi, the head of equities at Ambit Capital, is joining us ahead of that conference. Well, Pramod, good morning. Thank you very much for joining us. First, as you were putting together that conference, what was the first feedback you got from FIs? Is there a feeling of misdoubt, considering that their participation has not been as large as the domestic participation?
FIs continue to be positive on India, given that the nature of the economy is largely dependent on domestic market as opposed to other emerging markets which are reliant on the global economy. So to that extent, India continues to appeal to them. So although I wouldn't agree that there is a left out feeling, because we've had FIs pouring in money in the preceding years. In fact, those investments have really made a lot of returns for them. So I don't think the last 8 months suggest that they've had any serious issues about India as an investable market. If at all, like I said, it does stand above amongst other emerging markets. So to that extent, I think FIs remain quite positive on India. Although at the margin, I think there are concerns around valuations, ability to find good quality companies which continue to be re-rated upwards. Can we find good quality companies at reasonable valuations? That remains a concern. And also about earnings growth turning up. So they've seen pockets of earnings growth in several sectors or small and mid-cap names. But across the board, corporate profitability turning for the good, that's again another question being asked. But otherwise, from a long-term perspective, quite positive, quite happy with the way the political stability has come through, which also has been followed up with some reforms and hopefully more to come.
Pramod, good morning. That was my next question then, because how do you justify valuations in some of the companies that you're presenting? Most of them are trading not just above median valuations, but historically high valuations.
It's a matter of investment horizon. For an investor with a relatively long-term view, the current valuation shouldn't matter too much, as we've shown in our own research that the entry valuations matter little if your investment horizon is 3, 5, 7 years. The longer it is, the less concerning it is. But for those with a relatively shorter term, yes, you want to know when your exit is, and hence in that period how the market will behave. So any sort of concerns around the market perhaps consolidating around here or even taking a short-term correction, these are genuine concerns for short-term investors. So we've seen investors of all types and this continued interest in companies, even though they are fairly richly valued.
Okay, Pramod, morning. Can GST derail this rally just in the very near term, or can we say that the market knows that the near-term pressures exist and has priced it in already?
Difficult to say what's priced in, but speaking to investors, I think there could be some surprises because the sort of channel destocking ahead of GST, or the preparedness for GST itself, both by corporates and the government, and the potential disruption. I think everybody is cognizant that there will be some disruption of sorts in the first few weeks, if not months, of the GST going live. But how big is this disruption going to be? I don't think there's much sense about that. So there is scope for disappointment. But having said that, like you yourself mentioned, this market has been a rally driven by largely local funds, which continue to see significant inflows. Whether those inflows will stop on the back of this sort of disruption, perhaps muting earnings growth, I'm not so sure, because in a liquidity-driven market like this, short-term earnings certainly wouldn't matter. So on the back of, say, H1 earnings getting hit, will there be a correction? Not sure, but if there is one, that's clearly a good opportunity to get in.
Okay, well, I'm looking at the list of companies you all have invited, and Havells is the one that stands out for me. Great company, yes, great franchise. But are investors really willing to pay this kind of valuations that it is commanding right now?
I mean, like I said, like most mid-cap stocks, Havells is the largest mid-cap stock now, but most good quality companies, it ultimately boils down to your investment horizon. Yes, it's had a great run. Whether that run will sustain for the next year or so, that's a big question mark. Maybe, yes, there are challenges with the first 6 months of GST, valuations being high and so on. But remember, these are good quality companies. They have long track records of delivery. So for those who are taking a longer term view, this is a strong structural bet, because this is in an area which will see massive shift from unorganized to organized, and hence irrespective of how the economy does, irrespective of how the overall industry demand does, simply by taking market share from the unorganized sector, companies of these sorts will be able to deliver superior top line growth and earnings growth if you're willing to take a relatively longer term bet, like 3 years and over. So I don't think much of the investors here are concerned about the here and now. It's more about the sustainability of growth.
The other one that stands out is Ashok Leyland. It went through a bit of a brutal correction, but this year it's shown a decent bounce back, up 17% thereabout. Do you get a sense that the CV cycle is repairing? And in that sense, do you think Ashok Leyland is now placed well?
Yeah, I think Ashok Leyland had a great run there, but we've had a few sort of disruptions in terms of the demand. But having said that, you need a more sustained industrial recovery in the country for commercial vehicles as an industry itself to demonstrate sustainable growth. So we're all waiting for the investment cycle, which can trigger the industrial cycle as well, which has a direct bearing on the commercial vehicles growth. But having said that, Ashok Leyland has demonstrated significant market share gains in the past through some innovative product developments, and that's a journey that they continue to traverse. And so the underlying growth could be through market share gains, and if at all we see an industrial cycle recovery, you will see the industry also grow. So that augurs well for a company like Ashok Leyland.
Okay, that's about the auto space, but you're also profiling DCB Bank, which had a very good run along with Federal and Karnataka. But this is not an undiscovered story, Pramod. Why is the market so excited about these stocks, which have been there for so many years now?
Yeah, I mean, these are old banks, no doubt, but some of them have had a transformation through change in management teams which have come from private sector banks or foreign banks, which have put in some quality systems and processes to make the bank more new age than a traditionally run regional bank. And in fact, several of them have expanded pan-India, that they are no longer dependent on a specific geography whatsoever. So to that extent, these can be called as sort of quasi new age private sector banks, which have been driven off market share gains from the public sector banks, and there's no reason why the same philosophy of continued market share gains from the public sector banks to apply to these banks as well. So to that extent, they're perhaps exposed to the same sort of fundamental growth prospects, yet are relatively inexpensive compared to the genuine new age private sector banks.
Okay, and finally, has a time come to look at valuations and hunt for bargains in IT and pharma? Have you seen some of that play already in at least some stocks?
I think it's more of a selective play in both these sectors. There's still no denying that they have genuine headwinds, some structural, some cyclical. But having said that, like you mentioned, given where valuations are, there is some sort of margin of safety building up in specific stocks which are perhaps better placed to face these headwinds and will sooner or later come back to sort of a neutral growth trajectory. In the last couple of years, perhaps have fallen off that, if not going back to the go-go years of their growth levels. For IT, for example, from the current 6-7% growth, if they manage to get to 10-12% growth, not the 15 to 20%, but 10-12% growth is reasonable for that sector. So that can re-rate at least a couple of these companies to give significant returns for investors. Similarly, in pharma, again, I think a couple of them are slightly better placed, either because of diverse markets, not heavy reliance on the US and its pricing power, pricing pressure, and also having put some of their FDA issues behind them, can look forward to a more smoother growth journey. So, yeah, so the sectors lend itself from a value perspective, but I wouldn't think the opportunity is across the board. Recommendation remains to be selective in nature.